Welcome to everybody. I'm Riccardo Tambara, and I'm hosting the special webinar series on fundamental analysis indicator right from Milan in Italy, one of the epicenters of coronavirus. Hope that everybody is well. And so today we're going to talk about fundamental analysis indicator. So we're just focusing on sheet, cash flow, and income statements, and how we can use the line items taken from these documents in order to enhance our investment performance. So we're not going to talk about the momentum or technical analysis. We are borrowing a bit from estimates, and I'll show you in a minute how we can do it. So I promise you that this is the only piece of theory that we're going to get in this webinar. And for those who are not familiar with this formula, this is the dividend discount. So while pricing a stock, we are actually looking in the future. We are looking about what we are going to get a specific stock, assuming that we are doing it for a definite period, in terms of shareholder return. So dividend discount model was actually first published in the 1950s. And at the time, of course, the preferred way to pay investors for companies was dividends. So here we can see that the current price should be the sum of all the future dividends discounted by a discounted factor, which depends on the risk of the market and of the single stocks. And of course, it depends on the number of dividends that we are going to get. So this is quite clear, of course, if the company is paying a dividend right now, but if it's not, it may seem a bit stretched. And so it helps to classify different stocks, different companies, to be precise, as growth companies, so companies that are not paying any dividend or anything at all to investors, and cash cows companies, to borrow from Boston Consulting Group definition. And of course, we are going to start with cash cows because it's much easier to understand this relationship. So let me share my folio page. You should see this. Right, so here we have bring Apple stock, and the first thing that comes to our eyes is actually the forward dividend yield, so the yield that we expect from the next 12 months. It's quite skinny, as it seems. So we have to for 100 years to get back our say 100% price that we pay. Well, actually, we are getting much more than that 1%, because yes, our dividend yield is 1%, but we are actually getting something else, which is buyback. And buybacks were not in vogue when the dividend discount model was first invented in the 50s, but became more popular from the 1980s forward, thanks to favorable taxable regulation for companies. And so this is much, we can actually think that summing dividend yields and buybacks yield can get us a much better view on how much the company is paying us. So at 7%, actually, you don't have to wait 100 years to get back our investment. Isn't that right? But the point is this dividend, or at least dividend plus share buyback, so total shareholder yield, really sustainable? Because it seems like, comparing to price earning, it's a bit high. So let's dive into the financial statements. So this is panels, which is a functional folio where you can, see a lot of details of the company, and you can actually customize this a lot. I invite you all to have at least the financial report as a panel. You can quite simply, sorry. So you can quite simply, do it by adding annual statements to your panel. But you can also have here a lot of views that allows you to have a much better visualization of financial data. So here we have balance sheet, income statement, cash flow statement, and we are going to start from the cash flow statement here, because buybacks and dividends are paid in cash. So if we take the last 12 months, we are seeing that actually cash from operation, okay, is actually higher than net income, even after take out capital spending, which is the line item that represents how much the company is spending to maintain its assets. So if we are by subtracting capital spending from cash from operation, we are getting free cash flow, and the free cash flow, which here is about 67, actually doesn't cover. Oh, somebody is saying that can see raw things on your screen. So now I'm trying to highlight total cash from finance. Can you see this? Okay, I'm getting different most of people are saying yes, but there is one guy that doesn't. Well, if you can see a specific row, please check at the end of the webinar, the recordings, so that you can actually see whether it's a delaying problem or not. Could be due to connection. So here we are seeing that what it's paid in equity and dividends is actually higher than free cash flow. Okay, so we can say quite safely that this dividend policy and buyback policy isn't going to last much longer at this rate, because company is actually, as we can see here, selling a lot of investments, mostly, since we're talking about Apple, in the long-term corporate bonds, because they have a lot of purchase, we may say, in terms of cash equivalent and investments in the other securities. Right. So we started with shareholder yield. So if you are looking at how much the company is paying you, just don't look at dividend yield, but also at buyback yield, which is the negative of this number, which is positive. So it's 6.6 plus 1, around 7.6%. And now I want to highlight better what's the relationship of valuation, because this is a valuation, is at the end of the day a valuation ratio, just like price earning, price to sales. We're just looking at we're just looking at how much of those earnings is going in the hands of the shareholders. And now we are going to explore a bit better the relationship between valuations and growth. And in order to do that, we're going to use fundamental charts. So this is Exxon, of course, the big oil company. Oil, of course, it's not the most desired asset at the moment, and we can see it from the price itself. So, going to add to sale. So a measure of what the market is expecting the sales to be going, because as we said before, if the dividends are going up, so if they are growing, actually the price will be quite high and the valuation itself will be quite high. So using current fiscal year sales divided by sales TTM. So we are taking the expectation of this year's sales against the sales from the past 12 months. As we can see here, there is quite a strong relation. Take it further, you can really see that, of course, the price is reflecting what the sales will be in the near future. And in the Exxon case, actually, it's probable that given the current oil prices and production, this is not this is not going to last for just 1 year or two, but probably it's going to affect the profit margins of Exxon for quite a long time. And here I would add also another factor. So here we can see that also a profitability factor is going down. Okay, so at the end of the day, we can say that valuations are reflecting what what is expected from the market in terms of margin and sales. In this case, we don't have yet an estimate for different margins like EBITDA, gross margin, which are different margins on the income statement that are derived by subtracting from total revenues different different expenses. For example, gross margin, we are just going to deduct the cost of sales, but we are taking out all the depreciation, amortization, taxes, and the other operative expenses. So let's go back to Snapshot and try to take a look at valuation for companies that still don't have a bottom line, such as companies who doesn't have any earnings. So we are looking at Square, which is a company in the IT services sector. In particular, it provides a payment solution for businesses. And as we can see here, valuations are quite high, relative to, for example, Exxon. And it's quite easy to understand why, because growth rates are much higher. So we can expect more more cash flow going into shareholder hands in the future. Right now, what the management is doing is not looking at the bottom line, which is, for example, earnings, because they are investing as much as they can directly into the growth of the company. So in the Apple example before, we saw that actually Apple payment to shareholders is pretty high, but it wasn't that since a few years, when the growth of Apple actually, see here, came to a plateau, and it didn't rise as much as it did before. And so management decided that it was time to pay back to shareholders what they owed. So turning back to Square, of course, price to sale, and it does reflect a very different annual growth rate. Now we are going to use the fundamental chart in order to find something a bit different about these indicators, and how they can actually help us to really understand which companies are worth investing in and which not. So here, that's right. Much better now. Yes, there was an issue because that was not a percentage, now it's a percentage. So, of course, here there is something amiss. I mean, we're looking at the price to sale for Shopify, another IT company specialized in payments. But the price to sales is going to the sky, literally. But, sales growth estimate didn't change that much, and growth and the profitability measures didn't either. If we look at Square, here there should we could live slightly different approach. Right. So in here, you can see that price to sales is in line for what's going on in sales growth and gross margin, but in Shopify is not. So either there are a lot of information that we are missing here, and analysts are not just daring to estimate a high enough sales growth, or maybe this price is totally off, and we can say that this could be bubble. Of course, finance is not about certainties, so we can't be certain, but even if we look at different valuation metrics, well, we can say that it's better by any means to Square. And one other thing I want to point out here, if we go back to some, is that we can do actually better than price to sales, because price to sales actually doesn't take into account the financial structure of the company, in particular how much debt there is compared to compared to assets, and in particular cash and equivalents. So let's use a slightly different factor, the sales. Let's take this out. Still, of course, enterprise value, taking into account that Exxon actually has a much higher debt load compared to his cash and equivalent line item, can actually see that it's not its valuation is not as low as it may seem at the beginning, but it's slightly better. Of course, nothing compared to the other two. as we can see here, where the difference is not much, because if they have any debt, is actually quite close to what they have as cash. Because from a financial strength perspective, having debt, but at the same time using that debt to have cash at hand is actually quite handy to the business, and it shouldn't really impact the valuation, because the company is just keeping cash there, you know, in case there is, for example, you know, an unexpected shock to the company, so that it can, you know, finance its operations without having to ask for any loans or to emit any bond. Especially in a moment like this, where of course a lot of companies are rushing to the bond market and are getting not the cheap, you know, cheap price tag on the bonds so that they are issuing. And just to give you, you know, a sense of what's going on Shopify, and let me get back here. Okay, so price to sales 54. Okay, we have a 40 or 50% sales growth rate. We are going to look at Amazon 10 years ago. So I admit that 10 years ago, you know, we just went out of the great financial crisis, so investors were quite wary. But still, price to sales was 2, okay? And although gross margin was half of what Shopify has, that doesn't justify, you know, a price to sales divergence so high. And I mean, Amazon at the time was valued at 55 billions, while Shopify now it's 71. So, of course, if you compare different stocks, you can actually really understand how much expectations are baked into those stocks, and how much the market is actually expecting those stocks to be 5 or 10 years. And here the market is saying that Shopify is going to be better than Amazon, you know, 10 years ago. And wow, that's really something. Before, we also talked about you know, financial strength, and for this reason I want to pull off Microsoft here. So for financial strength, a lot and generally quality screens, a lot of times we are looking at the total debt to equity ratio. I think that's a stretch. It's a stretch because if the company has enough cash to pay down all these debts, it doesn't really make sense to look at the total debt ratio, but you should instead look at net debt ratio. So you should definitely take out all the cash and equivalents, and maybe also other investments, because in there some companies, there are a lot of corporate bonds on the balance sheet that they just have there in order to sell and get a better return, as in the case of Apple and Microsoft. And so in this case, actually we can say that it's a very safe balance sheet, because cash and total debt, let's take a look at how they are right now here. So we can see almost 140 billions for cash equivalent for Microsoft, and also quite some other non-current assets. A lot of times here there are, as I said, also long-term securities, and on the other side, long-term debt is low. So here, what it's saying to us, also we might also remember Apple before. Apple was actually selling down its cash and equivalents in order to pay a higher dividend than sustainable. So in Microsoft, we can say that in the future, there could be a lot of dividends that could be unlocked by just changing the financial structure of the firm itself without taking too much risk, of course, because there is so much cash in here. I would also argue that you should take off cash when you calculate financial ratios such as for others, so that for example here we have a market cap of 1,300,000,000, and you know, this much cash, this PE can actually be revised lower by 10%, because this is plus, yes, 10%, without impacting too much on the risk of the company itself. So probably you know, you can think about price earning or price on free cash flow or similar measures by taking off 10%. We are going to see at the end of this webinar also how we can do it in a investment strategy. And in order to sum up here, I also want to highlight a couple of things on profitability ratios. If I were you, I would trust return on equity up to a certain point. Why? Because there are companies, for example, Philip Morris here, the tobacco company, for which you cannot calculate it. So, of course, higher profitability equals higher valuations, and that's quite easy. But if you just look at the return on equity, you don't get the full picture, because first you have you have companies that have a negative value. So you're just looking at the equity of the company, and sometimes this is even negative, so you cannot even calculate it. But even if you calculate it, if the equity is diluted, well, it's not diluted, but is reduced from, let's say, M&A activity or buybacks themselves, actually you can get a distorted ROI. And while on the other side, if you take return on assets, okay, you are going to have other distortions. So, for example, if you have too much cash, that's not the case here. Actually, you are not you're not seeing the full picture of how the assets are generating returns, because a lot of those assets are cash. So here, I would definitely strip assets. I would definitely strip, sorry, cash and equivalents from assets in order to have a better version of the profitability, real profitability of the company. So, talked about growth rates. We talked about ratios of valuation. We talked about profitability, and we talked a bit about financial strength. But how can we put this to work in an actual, investment strategy? I wouldn't take any of those line items by themselves. So I wouldn't jump straight into low PE ratios, in the hope that growth rates are wrong, because most of the time it's not the case. If you are going to get just plain, or if you just have high profitability companies by looking at nothing else, it's a dangerous exercise, to say the least. And so now we are going to see a quick screen where we combine all the things that we discussed so far. So here we have first ranking system. Okay, this is, I'm calling on a long rule a ranking system that looks at expected sales growth rate. Okay, and I'm doing this for the SP 500, thinking of course as benchmark and as using the SP 500, and we are combining that with what I just told you. So a return on equity, a return on asset metric, which is actually enhanced by subtracting cash equivalent, so that we can have a better version of what assets are really generating for the company. Here, I'm going to add a quick rank, which is a simple, let's say, operating cash flow minus capex, capital expenditure. So we're talking about free cash flow divided by enterprise value. Okay, so this is a valuation metric which looks not much at net income, but more at cash flow generation. And cash flow generation that assumes that there is at least some expense in order to keep the assets in good shape. So we are taking the top 20 stocks here. Look good. Well, first, let's take a look at what are we picking. So let's take a look at sample value. So we are not getting too extreme on price to sales. Of course, we have MasterCard, but MasterCard, it's actually a company that has a lot of growth, as we can see here, and also have a very high profitability. And about the other companies are companies that have a lot of expectations for sales growth and high profitability, and in those clusters they are the ones that are actually showing better valuation ratios. So let's give it this a shot. Last 5 years, I remind you that it's quite a difficult period because of large cap performance. So there's screen is backtesting using equal weight, so we are tilting the performance more toward equal weight and the lower cap stocks, and this actually did pretty good. As we can see here, it's not what we are picking here is those are not value traps. Those are not companies that are that have very good valuation ratios because their sales are going to be bad, but those are companies that have favorable valuation inside clusters, companies that are probably going to be around next 5 or 10 years, and or at least this is what profitability is telling us. And not only this, but those are companies that are probably going to reward investors also for that by distributing a lot of those cash flows that they have. Or if they don't distribute it, at least they are using it inside the company in order to generate even more revenues. So I hope that this was helpful for you, and I hope that it was mostly clear. And now I'm taking a look more into the question that you have in chat. I already have some. If you have more, please write them down. Well, RTNL. So we are not sure that not current asset is security only. Of course not. We need more about it as line items. Some companies don't even have that kind of information, and currently we don't offer that line item yet, even though we are switching to FactSet, and we are going to get more line items so that you can do better analysis. But of course not. You cannot be sure that those are securities only. That was an example for Apple, and I did actually went into Apple annual report, and I saw that most of those non-current assets were securities. So view the rule of the simulation again. First, so the rules here, we have next fiscal year sales estimates. Okay, so this is the mean of the analyst sales estimates. Okay, for next fiscal year, and here we have current year. So this difference, of course, -1, but you know, for this rank it doesn't matter because we are just looking at it as it is. So here we are screening for companies with very high sales expectation. Here we are taking a look at the profitability ratio, custom one, which is return on assets, okay, net income, and the return part is net income, and assets are adjusted for cash equivalent. Of course, here to cite your example, I'm not taking out non-current assets because, of course, nobody's sure whether they're securities or not, and so this is quite conservative. But if you're valuing companies that actually you are sure that that item they have or securities, of course, you can take out more pieces of the more line items of the total assets. And finally, here we have free cash flow divided by enterprise value as standard valuation metric. And of course, Marco is asking whether there is a possibility of recording. Of course, this is recorded and will be published on the website. And as soon as it is, we are getting a notification via email. Can you please go over debt analysis for one company a bit slowly? Thanks. Right. Okay, so we are going to debt analysis again. I'm just thinking about another company that we can take as a better example. So let's take Apple. Panel. Yes, sorry if I was you know, bit fast, but we didn't have much time. I didn't want the webinar to be too long, so maybe I fast forward a bit too much. So in here, so we have long-term debt at 91 and short-term debt as at 16, and we're talking billions. And so the sum of these two is actually higher than cash equivalents. But if we take into account that non-current assets that are also a lot of securities, we can say that there is some leeway for the company to invest more or to pay more to shareholders. And you as a company or as a CFO of a company, you can do it as long as the debt market doesn't punish you and you don't get punitive rates. And something else I didn't mention as another indicator, which is widely used for assessing how much debt can be on a company balance sheet without hurting too much investor confidence. So we're taking debt total TTM times cash. Well, let's score times cash equivalent order right? So this is net debt, and we divide it by EBITDA, TTM. So in this way, this is net debt EBITDA. This actually measures how many years a company earnings before investing. Sorry, here there is. This is correct. How many years the company has to how much it takes for a company in years in order to pay off debt investors using all the cash that they have, and also using future earnings without investing anything. So with taking out the depreciation and amortization. So it's an error. So sure it isn't working. Yeah. So this is TM. Oh, there it is. Taking a different color. Of course, in terms of Apple, this is not much. Where we can say that investors, at least for public company, gets a bit wary when this indicator is above 2 or 3. To give you another example, private companies in leverage buyout can be both even at 5, and so this is definitely not high. So in order to do a bit more of debt analysis, you definitely want to look at the net debt position, and to confront it with margins like a gross margin, or even better, EBITDA margin. And if you want, of course, to have your company growing, of course, it's even better if you can pay off debt in not many years, just looking at the net income or EBIT. So I hope this is a bit better, the debt analysis part. Is it possible to simulate 20 years? Of course it can. So it's possible to simulate with 20 years. Of course, you need a special subscription in order to do that. So here I have administrative privilege, so I can test from here. So between 1999 and 2007, profitability as a factor didn't work as well. If you use the just valuation and growth, you would have got much better results. And but in the recent years, just valuation and just growth are not working anymore. So right now we are experiencing a shift towards this type of indicators and or factors. But of course, you can backtest as much as you want, provided that you have the right subscription in order to do that. Of course, with the lower subscription, you just have 5 years, and advancing, you can get more. With the facts and transition, we are going to have 20 years for backtest and portfolio, and 5 for screener. And from now to the end of June, the maximum is 15 years. So I hope that was clear. Anything else? percentage that were profitable trades. Yes, it's possible. I don't think it's possible on the screen. So, sorry. No, in order to do that, you have to, in order to see how many trades were winning compared to how many were losing, you have to go to simulated strategy. But yes, it's something that it's calculated on. Right. So to wrap up, because we are quite late, let me just share screen. Okay, I just want to tell you that if you have any other doubt, you can contact directly me at riccardo.t portfolio123.com. And if you didn't see last time how to use the ranking system by Paul DeMartino, I strongly suggest that you do next time available in a couple of weeks. And of course, if you don't have a membership, please try a free trial so that you can also try everything that we did here and even more. And I definitely hope to see you next time. Thank you all.